Let's connect with A. Bala. He's the Chief Executive Officer with Birla Sun Life Mutual Funds. Bala, morning. This is Nikunj joining in from the Mumbai studio. Bala, last 8-10 days have been very choppy and volatile for Indian markets. First, we saw a breakout, then a breakdown, and then we saw a triple-digit recovery yesterday.
Yeah, I think it's a function of the volatility what we have witnessed actually in the global market, and second is some of the expectations that are building up with respect to the monetary policies. One, of course, in India, and second is globally some of the statements that were coming with respect to the way forward. There was some kind of mixed signals which I think was being misread by the market and which created some kind of volatility. I think having said that, I think the large level of the commitment and the interest continues to remain very, very strong with respect to money coming into the emerging market, and even despite all the volatility, the last 2 weeks, the global liquidity continues to be the driver of flows. That's what we have witnessed actually even in the Indian market as well. There is an element of interest at every level, but at the same time, having seen a significant move in the market for quite some time, I think the volatility is bound to be there. But at the end of the day, both from the portfolio manager's point of view as well as the investor's point of view, though the market volatility is going to probably remain for the coming few weeks. One is because of the result season, second is the expectation of monsoon, and third is the supply of paper that could come from the government of India in the form of OFSS on some of these public sector investments. All those things will of course keep the market volatile. At the end of the day, one has to focus on the fundamentals of the companies and where to position yourself more to overcome the volatility, or maybe have a lesser impact on the volatility what we have seen in the market.
But Bala, do you think the last leg of earnings have clearly disappointed markets? We got a shocker from SBI, we got a shocker from L&T. None of the banks have conducted themselves very well. Metal stocks are under pressure and pharma stocks are fully priced. So where is the upside trigger?
I think one has to look at one on a relative basis within the same sectors what could do better. As we always been maintaining for quite some time that while there has been a case actually for cyclicals, so-called cyclicals, given the fact that interest rates would come down, and given the fact that a lot of push is being given actually for the revival of the economic growth. Having said that, at the end of the day, market will look at clearly on those and differentiate more from the point of view of volatility. At the same time, continues to pay actually a premium what the probably the deserves for stable earnings growth what the companies are reporting, and give them actually a better price discovery. And that's why I think we have seen it happening. For example, FMCG sectors continues to outperform despite knowing the fact that the valuations are a little stretched and the valuation is costly, but at the same time the earnings volatility has been relatively less compared to the other sectors. The same thing which you have seen actually in the case of private sector banks. Some of the private sector banks have done far exceedingly well compared to the public sector banks, given the fact that they have been able to report quarter after quarter, year after year, stable earnings growth compared to the other public sector banks. And that, I think, is the question of where exactly you position yourself. That has been the challenge which you have seen for the last many years, especially last 2-3 years, that continues to remain even today as well.
Bala, so if you really have to map the global picture, how would you sketch the global picture for us? Because globally things are divided. One side you've got Asia, where China and Japan, they both are in a mess. The other side you've got developed markets where Europe has improved and US equities are sitting at a new all-time high. Do you think the world is clearly divided into two halves now?
So I think the one other thing which is being seen as positive in the global market space, especially in the global economy, the steps that are being taken by Japan, which we call it as an Abenomics, whatever is now is being called. Clearly, I think is actually an attempt that is being made using one of the developed economies such as Japan to revive the economic growth within their own country, which will in some sense have an impact on some of the other global economy. And second is continued the commitment coming from the global developed economies to keep the liquidity easy. That once again gives some kind of certainty for interest rates movement. That gives some kind of certainty in terms of flow of money that is coming into the emerging market. The last point, which very interestingly we had observed, that the level of the growth or maybe the support that is coming from the Asian economy, including Japan, to fund actually the Asian growth, which has been the new theme which is emerging, where given the fact that Japan has been focusing on getting back on inflations, getting back on growth, at the same time keep the interest rates low, so as to actually ensure that the money flows remains somewhat easy and liquidity remains somewhat easy. As a result of that, money could flow into the emerging market, which including Asia. So there's a theme which is getting, of course, emerged, is that whether the Asia can fund actually Asia growth, which is what I think of late we are seeing it as part of the debate and discussions is coming from Japan. I think most of the global economists are actually turning somewhat comfortable and bullish on the developed economies such as Japan, making an effort to actually get back on growth, which in some sense should support actually the global economic growth. Having said that, clearly the crisis that we have seen actually in the European market remains, and the US of course is actually the borderline case where things are coming back. These are some of the positive signs more from the India point of view, given the fact that a lot of efforts are also being made in India to revive the economic growth, mainly through pushing through some of these investments related spending, both through the private sector as well as public sectors. Maybe these are some of the things where we may probably have an edge over some of this global economy in this time.
Birla, so how does one approach individual sectors? Let's start with pharma. In a volatile time, one would tilt towards defenses, but then again, ex-Ranbaxy, the news flow seems positive, but then you have Ranbaxy on the other hand, wherein, it's such a developing story and so negative at that. So how does one approach this space?
Yeah, I think this is a challenge which we face almost on a day-to-day basis or month-on-month basis. I think, as you rightly put it, some of the stocks which of course have been extremely volatile. I think it's a question of how the earnings of these companies have been panning out, and how the balance sheets are being built, and how some of these products propositions have been contributing to the overall growth. And some of these companies, if you look at one, of course, they get into some bit of controversy, which was probably not expected and not priced in the stock price. There are certain companies within the pharma space have got very large concentration on one product and one market. These are some of the things when we look at as a portfolio managers or maybe the fund house, we do avoid investing in such kind of companies, knowing very well that it may hurt you on the short-term performance. At least you are able to stay away from the volatility which potentially the stocks could offer. That's why I think we, of course, keep discussing most of the times. It's not the question of identifying the stocks where you have to make an investment. It's also equally important to identify the stocks where you have to do a smart skipping.
Birla, but if I look at your last declared portfolio, you have a very large exposure to commodities. You own Kane India, you own Reliance, you also have exposure to Hindustan Zinc. At a time when China is slowing down, what is the proposition there? Why are you buying into commodities?
I think clearly is the exposure is what we have with respect to both. There is a clear gross underweight to the index weight. At the same time, one need to have an exposure only to ensure that whatever in this volatile period, you need to also ensure that the performance of the schemes is actually making an effort to beat the index by about 2 to 3%. Keeping that as a benchmark, as a concept, when you look at actually the aligning of the portfolios, we have to of course pick the best picks among them, which will of course not get impacted by the what you mentioned about the Chinese economy slowing down, could have an impact on commodity prices. The global volatility, what we are witnessing actually in the commodity prices, you need to of course stay away from that. At the same time, pick up something where the balance sheet of these companies are far better, and the company's ability to generate cash is far superior. And all the three names, if you look, the names what you took, they actually are having a very strong balance sheet, very high cash flow generation capability. At the same time, the ability of these companies in any uptick is far superior from the point of view of generating return to the shareholders. So that's the way we have positioned our portfolio. That does not mean actually I've turned bullish or positive on the commodities as sectors per se, but I think it's somewhat related to the how much is underweight or overweight you can be in these kind of companies when it gets related to the index weights.
But Bala, on an aggregate basis, midcaps are making a comeback in your portfolio. Aurobindo Pharma right at the top there. Hindustan Zinc 3% exposure there. LIC Housing Finance about 3% exposure. So are you of the view that now second half it's time to load midcap stocks? Or these are individual companies you still think that midcaps as a category will underperform?
I think one of the point which of course we keep discussing internally is instead of looking at whether it's a large cap or mid cap, so ultimately all these stock picking have to be done on the basis of the quality of the companies in terms of the business outlook, as well as the quality of management and the quality of earnings what these companies have been reporting. It may fall of course in the mid cap space, ranging from say 5,000 to 10,000 crores market cap, or may probably fall in the market cap in excess of say 30,000 crores or 40,000 crores market cap, which generally is called as a large cap. And that's an approach what we have been taking. And some of these schemes such as frontline equity does have actually mandate to invest up to say 10 to 15% exposure in mid cap. And within that space, depending upon the market view, we do change our allocation to the mid cap from say 10% to 15% or maybe 15% to 8%. But that we essentially focus not by taking a call actually the mid cap is going to perform better or not. I think it's more by taking a call on the basis of what these fundamentally these companies could offer in relation to some of these large cap companies, more on the valuation basis, as well as the management commitment actually to build the business to the next level of growth, which could eventually take this company actually to much bigger than what they are today. And that's the kind of approach what we take. The last which you have implemented as a fund house we have always been following is whichever segment in which you look at it, ultimately we do look at the management scorecard of these companies, which is derived on the basis of not just only the management quality, even actually the balance sheet, right, the way they are funded, and the way the business is being built using their balance sheet, and the way that actually the growth is coming actually in these companies on a quarter-on-quarter basis, which reflects actually the quality of management, right, which you measured as part of the overall stock picking strategy.
That's the investment thesis which has to be in place. But a final question, the DI selling has been relentless. Even though the financial year has changed, the pattern has not changed. When do you think domestic institutional investors will stop selling this market down?
Frankly, of course, this question has been asked all the times for quite some times. Me being bullish, and we as a fund house being bullish in terms of building the business, the optimism continues to remain. I think still I believe that is just a question of time. I think the question of time would also be linked to some of the other asset classes, such as gold, which has been showing some kind of weakness. I think the second year consecutively we are seeing actually the gold as an asset class not performing to the expectation of the investors. At the same time, the volatility on gold as an asset class also is going up. I think some of the such kind of asset classes where the large pool of savings have been going, I think the moment they realize that asset class where the large proportion of money is invested is not actually delivering a return, I think that's the time I think we believe that we will see actually the large flow of money moving back to the mutual funds form of an equity.
Birla, let you go on that note. Really appreciate you taking the time out and joining us today on the show.